I am a professional buy-side retired, and I teach not because I need the money, but because I need something to do in my retirement. And this is great fun for me. Please get out a notepad and pencils because this is an educational format. It's not just promoting and trying to get you to buy something. So we're going to master some things. I am an educator. I don't trade for you. I don't tell you what to trade. I don't do any of that. I educate only. So I am Martha Stokes. I'm a chartered market technician. I've been a long-term member of the CMT Association, which is a big deal because there are not many women in this. I have an approved SEC Series 86, which gives me the license to do technical analysis and education. You should always make sure that anybody that you work with, if you're serious about stock trading, which is what we're talking about today, stocks and options, that they have some sort of initials after their name and have an approval by the SEC. CEO and co-founder of TechnoTrader with Howard Johnson. We're entering our 27th year of educating retail and professional traders, so we've been and stood the test of time. I am the author of 2 professional doctoral theses, The Cycle Evolution Theory, How to Identify Evolutionary Cycle Deviations. I wasn't trying to prove their cycles. We all know their cycles. I was trying to show and won the award of the CMT because I presented something that no one had ever thought about before, and that's deviations and cycles. And I wrote the professional doctoral thesis, Relational Technical Analysis, which expands the body of technical analysis in more detail for the modern market structure. So confidence comes from knowing what you can achieve. You can achieve your goals no matter what you are striving to achieve. It is not hard to gain confidence to trade stocks successfully. It is a matter of a proper education, as you've been told, that provides the knowledge that is not available from the internet or chat rooms or gurus or famous investors. It is taking charge of your trading and investments rather than hoping someone will be able to do it for you. It is about avoiding scams such as day trading is easy. It is not easy at all. It takes sometimes 3 to 10 years to become proficient at it. Each of you already are excellent at something in your life. You probably are very confident without realizing it for certain things that you do, your career, as a parent, whatever you do, you have confidence and you know you can do it. Confidence comes from doing something with ease, experience, and skill development. This training is about building skills and expanding your knowledge so that confidence becomes automatic. You will feel more comfortable by the end of this training that you can do this. The true problem is there are huge gaps or holes missing in your information, in your education. You have some basics from the internet and webinars, but you are lacking far more than you realize. There is an entire world within the internal market that you have never heard about unless you've been to one of my other webinars. If you want to earn monthly income no matter what happens to the economy or the world, then this webinar will start you on the right path. It is not strategies or backtesting or volatility or market makers that make you lose money. What is missing is an education that focuses on the market structure of the professional side of the market. The financial markets are not what you have been told, read about, or think. It is not Wall Street versus Main Street. Get that concept out of your mind. That's the biggest myth of all. Market conditions are just one area you need help with learning and using to your advantage. It is the most important of all the missing pieces about stock trading and what you have learned thus far. Everything you learn is good, but sometimes you learn so much that it becomes confusing because you need a central path that you go down. Market condition analysis is the climate or ecosystem of the entire market. Write down that term, market condition. We're going to talk about it quite a bit. Trading condition is the day-to-day weather. This is where you can choose a trading style and apply the appropriate strategy. Day trading is not a strategy, it's a style. Swing trading is not a strategy. It is a style to which you apply strategies that are relevant to the trading conditions and market conditions at that time. Predicting is impossible and tends to give you the wrong perspective. Throw it out the window. The poor weatherman can't get it accurate all the time. Nobody can. You don't predict. What you need is just like a weather forecast, a probability to a very high degree of how the trading conditions will be for the next day to week. You can do just like the weatherman, you can forecast with a high degree of accuracy what it's going to do in a few days, not what you can do next year. Oh, what's going to happen in 2026, Martha? Can you tell me what stock to buy in 2026? I'm going, no, I can't. So, bull and bear markets. Bull markets and bear markets are not an inversion of one of another. This is a big misnomer. Most people think, oh, the bull market, the bear market, they're all the same. You just invert. It isn't true. A bull market typically lasts 8 to 15 years and a bear averages 1.3 years. Why? Because a bull market moves up slowly over time and has corrections like we have a correction right now. And bear markets are a complete collapse of the market. There are different kinds of bull markets. They're not all the same. A minor bull market is an uptrend of a few years. There are no new technologies that are coming forward. Minor bulls occur when other financial markets, such as real estate or bonds or commodities, or even cryptos, are in a bull market. And so it moves into the stock market somewhat and creates this soft bull market like we had between 2012 and 2016. The average bull market has some new technology that is helping boost not only the stock market, but also other financial markets. There are 7 going on 8 financial markets that the US has. We have the largest stock market in the world. If you add all of the other stock markets of all the other countries together, the US stock market is still the largest in the world by a huge margin. Also, our other financial markets are huge. We are no longer a manufacturing-based economy. We're a digital economy focused on financials. So if you don't know about the financial markets, understand the inner workings of it, you're going to be left behind. A great bull market endures far longer, has far greater return on investment and trading gains. New technologies create great bull markets. The great bull market of 1929 was because there were new autos and all kinds of new appliances for homes, and it created this bull market. There was a bull market in the 50s when more and more housing and development people got more jobs and were wanting to invest, and mutual funds came out. So everybody was buying mutual funds. And then in the 90s, we had the great technology bubble. And that was because we had 6 new technologies coming to market all at once. Software, semiconductors, computers, PCs, all of this. Now, right now, we have AI that started last year, but we have 19 other new technologies coming to market, moving through in the next 10 years. This is going to be the longest bull we've ever had. So let's go through the bull cycle of market participants so you understand what's going on. We have buy-side institutions, also known as dark pools. I call them dark pools all the time. I interact with that. They trade on alternative trading venue systems that are not public. You can't see them. If somebody says, oh, I've got a level 2 or level 3 screen and you can see the big whales, you can see the big orders. Oh, 50,000 shares, 100,000 shares, woohoo! I'm going after these big guys. Sorry. Those are smaller funds with less than 3 billion assets under management. They are not the buy-side giant dark pools. The dark pools are not allowed. Nobody is allowed in there but the dark pools, okay? Nobody is allowed in there but buy-side or sell-side. We have wealthy private investors, all of your CEOs who retire, Bill Gates, Jeff Bezos. They know all about business, and the market is the business of businesses. If you understand business and how it works, you will do well in the market because it's simple. It's the business of businesses, and they do very well. So they get in at the bottoms. They create the bottoms, these 2. Then we have sell-side institutions. They are the big money central banks. There's only 6 left. There may be only 5 by the end of the year. And they are short-term traders. These are long-term investors. They're investing for the long term. So they're buying stocks with anticipation that over time it's going to go up. Sell-side institutions just want to make quick money to keep the banks rolling. And they do the underwriting. They do all the buybacks as the bank of record for all the big corporations, all the Fortune 500 and 1,000. So they're very busy doing all kinds of things. They also support the market. The buy-side institution will come in and support the market if it dips into the 20% to keep it from going into a bear. They've done that several times in recent years. Professional traders on the sell side are floor traders. You have professional
Traders on the buy side, which are floor traders that adjust and keep the balance of everything going on. These are the best of the best in the world. There are no better traders than these. They're also proprietary desk traders. Some of them are my students. Professional traders, independent, are a growing group of people. Some of my students have become semi-professional, professional, and are allowed by the IRS to trade as a tax status as traders trading as a business. So this is something that is very important for those of you who want to step it up and go beyond being just a retail hobby trader. Corporations invest in the market all the time. They do buybacks, which they shove to the sell side because they don't have floor traders to do that work. And they invest in private companies and small companies that they don't always take over. High frequency trading is very important. It is on the professional side. It is making or taking the market. They are paid to make liquidity or take liquidity by the huge public exchanges, NASDAQ, New York Stock Exchange, ICE, and so on. There are 50 dark pools, and there are about 13 public exchanges in the US at this time. The high frequency traders trade on the retail side, so pushing liquidity that direction because this group is absorbing massive quantities of liquidity all the time. These constitute 80% of all the market activity, which is about $300 billion exchanging hands every single day. So your 100 lot or 1,000 lot order gets lost in the ocean of $300 billion trading hands every day. They're not trying to hit you. They're not trying to take advantage of you. High frequency traders are. But we have the small funds, asset managers. Anything less than 3 billion under management is considered a small fund. It is not professional side at all. I'll talk more about those later. We have sovereign foreign funds. Everybody wants to invest in our market because we're the largest in the world and we have the most liquidity. We have the most secure market in the world. It's monitored carefully. Everybody wants to invest in our market. That's why they extended the hours. Means retail traders and small lot investors get in very late in the trade because before this was a bear market and you're scared and you don't want to get in. Oh, maybe it's going to turn, and every little blip and thing, then, oh, I don't want to get in. So you get in late. You wait and wait and wait and wait. And then finally you see the stock just like NVIDIA did last year going up. And all of a sudden you want to buy that stock. And retail trading chat groups get in late because this is the blind leading the blind. Nobody really knows what they're doing. Odd lot investors are those who are undercapitalized. They want to make money. They're desperate for money and they gamble and they get in at the top because as these groups get in, these buy side institutions start selling down. So this is 20% of all the activity is on the retail side. So if you really want to become a great trader and make lots of money independently and not have to worry about some guru telling you what to do, you want to trade with the professionals. And that's what I teach. So it inverts on the bear cycle. I'm not going to spend much time on this, but it does invert on the side. So the sell side institutions, professional traders are all selling short. High frequency traders trigger huge gaps down. They put their buy to covers way lower and they can enter a sell short order and just let it wait. Now, the interesting part about the downside is it isn't people driving the price down. It's voids. A void of buyers causes most of the huge collapses of the market is because nobody is buying, everybody is selling. These guys have been out for a long time. They got out way early, even before the top. And then the retail groups, chat rooms, and memes groups, as the dark pools are starting to buy, they're going, oh, maybe we should sell short. So they are trading against the buy-side institutions. Small lot investors and odd lot investors wait and wait and wait and wait. And if they're not holding, which they should hold, in most instances, there are some instances when you should not. When it's a great bear market, then you should not. But if it's a small intermediate term correction or something, they capitulate and sell at the low. And the buy side says, well, if you're going to sell your shares of stock at this low bargain price, we're going to buy them. Okay. Buy side giant institutions are called the dark pools. This is what you can see every day. This is what's hidden from you. We have a gift, so hang in there. They control vast inventories of stock in thousands of companies. They have trillions of dollars in assets. When they accumulate, the price is predetermined and is in a very narrow penny strike price range. Dark pools do not move price. They ping at a specific penny. Write it down. I call these buy zones. So if you see that on the internet, it was my term. It can take weeks to months for the dark pool to buy all of the shares of stock for a mutual fund or an ETF that they're developing. It takes time. When they open up an order in the morning, it can take 10 minutes to fill while they accumulate from different areas. Professional, independent traders and floor traders for the banks are constantly searching to find dark pool buy zones to create a nudge, that's my term, that will result in a gap or swing style or velocity style run of a few days to over a week. So the pro traders are nudging the HFTs, and the professional traders know where the dark pools are buying and accumulating. So the bottoms are where there's all this heavy activity that you're not aware of. You need to learn to trade with these professionals rather than against them, as you are doing now. You get in the morning, the HFTs have gapped the stock up and you start chasing it. Bad idea. And you wonder why you lose money. Professional traders are professional floor traders, proprietary desk traders, independent professional traders. A professional trades differently from a retail trader. You need to be more like the professionals, even if you never want to become one. They are aware of the entire body of market participants, what each is doing, and how that market participant impacts price and volume action. They know when they see a certain kind of candlestick that that's a dark pool. They know that dark pools use time weighted at average price, not volume weighted at price. That's a small fund manager. They are aware of who they are trading with and who they are trading against. They know this all the time. Professionals use special order types that are bracketed and commonly trade 1 to 5 million shares in a single transaction and can have as many as 10 different legs on that order to mitigate the risk of that trade. Are we following? And futures and options and all of this are part of it. They use special indicators designed to identify which side of the transaction the large lot triggered. And I have created those indicators and some other software that I work with. I don't have a software company. I'm not a software company. I don't sell any of that stuff, just education. But we have special hybrid leading indicators, which are just like what the pros have. Independent professional traders hunt for dark pool buy zones. That's what their whole focus is. If they can find that liquidity draw, then they can trade it. They create candlestick patterns, I call nudges, which trigger HFT automated orders. High-frequency trading firms systems are fully automated algorithms that function without human intervention. Yes, they are now using AI. They are the first to do so of the market participant groups. Most are still using the traders and the human traders and will for quite some time. HFT activity is mostly dominant at market open. So all those big gaps. HFTs have several strategies to which the computer program applies pre-programmed algorithm. HFTs fill the queues of the public exchanges with thousands of small lot orders, milliseconds. There are 60,000 milliseconds in a second. That's what they trade on, ahead of market open. You can't even follow that with your eyes. The computer of the market then adjusts the stock price up or down based on the number of buyers versus the number of sellers. So if there's more buyers, then there's going to be a gap up. If there's more sellers, there's selling orders, there's going to be gapping down. And HFTs base this on pro trader nudges, on dark pools. They do it on retail news, chat rooms. They get into your chat room. You have an open chat room, everybody's talking. They know what you're going to trade. Oh, they're going to buy that stock. So let's gap that up. HFTs create the huge gaps at the market open. Sell-side institutions, the giant money center banks and giant financial services are the sell-side institutions. JP Morgan, Goldman Sachs. Banks are the underwriters for the new IPOs and do corporate buybacks as the bank of record for all the Fortune 500 companies and others. Banks are short-term traders. The floor traders of the sell side are the most talented with the extensive experience and trade all the financial markets. They are the best of the best in the world. They have multi-leg orders that fill on the millisecond and front-run retail traders and investors all day long. The sell side and buy side have a hidden war that has been going on since 2008 for many, many years. Small funds managers, that local neighborhood broker that's so helpful and such a good salesperson. The small funds management companies are firms with less than 3 billion assets under management. They are retail side by SEC. The giant buy side have trillions of assets under management by comparison. Small funds companies, also asset management firms, do not have the capital reserve nor the experience, expertise, or skill of the giant buy side or sell side. Smaller fund companies are a big group of 10,000 to 15,000 companies and are often franchises. So they don't even own the company. Their limited experience and lack of formal financial services degrees puts them at a disadvantage. These are people pulled off the street who have very little knowledge of the stock market. They pushed through a real quick training session, and then as the franchise works, they work as salespeople selling mutual funds and ETFs and so on that the large corporation behind it wants them to sell. They often are on the wrong side of the trade if they try to actively trade their account. They're constantly doing that and losing money. Foundational knowledge. There are 6 primary market conditions: bottoming, platform, moderately trending up or down, velocity up or down, topping, and trading range. You can write those down. Each market condition is unique. The trend line patterns are different. This is because different market conditions are created by different market participant groups dominating and controlling how price moves up or down or sideways. Market condition is your weather forecast for navigating the market activity. You will trade differently in a velocity market than in a platform market. The stock market cycles, and each market condition is a different part of that cycle. So, bottoming market condition. Bottoming market condition is exactly what the name implies. The indexes and broad base of stocks have been in a bear market or intermediate term downtrend. There are many shapes to a bottom: bowl, rounding, triple, V, U, and basing. Short term, it'll be a V or a U. A longer term, basing or a bowl bottom. Buy side and giant institutions create all the bottoms. They slow the selling down. They're like a brake on a car when there's another car ahead of them. Slow it down, slow it down, slow it down. And then suddenly a shift of sentiment, and then it will start moving up rapidly. When stock prices fall below fundamental value levels, and yes, you can see it in your stock charts, you just need to learn what it looks like. It's a technical pattern. Dark pools start buying bargain price stocks. During the bottom, retail groups are afraid of the market and will go up or down, and so retail groups hesitate and often sell at or near the lowest price as dark pools are buying, or they try to sell short into a bottom. It's like, oh, don't do this. And I see it all the time. Retail news is full of fear, negativity, and misinformation. When the news is really bad, the bottoms will begin. When the news is really good, the tops will begin. So this is a long-term bottoming formation. We can see it was slowly, they started accumulating right in here. Slow it down. Smaller funds just sell on the bounce, sell on the bounce, sell on the bounce. They're selling into the bottom. Bottom forms definitely here, and then pro traders nudge it up. Platform market conditions follow a bottoming market condition some of the time. It's usually after a big bear market. The platform market condition is only taught by me because it's the only one that I'm the only one that identified it because of my cycle theories. Platform market conditions started appearing in 2002 when the market switched from fractions to decimal pricing, because a large group of sell-side banks went to the legislator and said, oh, it's so unfair for retail traders and investors. They just can't do fractions. I guess they never thought that anybody went to school. So they changed it to decimals. They wanted the market to be more efficient, and they made it too efficient. Dark pools strike the penny or half penny in a narrow price range, creating this new type of trend, which is wider and longer in long term than a consolidation, but it has very distinct highs and lows. You can put a rectangle around it. Dark pool TWAP orders create this market condition because they ping on the penny, they ping on the penny, they ping on the penny. The market price is going up and down, and it pings across over time. Buy-side giants create and control the platform market condition. They are in entire control whenever there's a platform market condition, because most retail investors are terrified of the market and they're so afraid it's going to crash again. Professional traders search for these patterns to create nudges and triggers to move price upward via HFTs and smaller funds managers buying after that. So this is how it works. We have a bottom, it completes. Pro traders know this. So we have these little nudges going on, this sideways action. Then HFTs gap it up, and then it goes sideways again and sideways again, and dips down a little bit, but pops right back up. If you have a day where it goes down below this line and pops back up, that's because it went out of the buy zone, and the dark pools immediately triggered and pushed the price right back up. So we have these platforms all along, and yes, we're confirming it with all these indicators that I have written for specific charting software programs. I also have public versions of this as well. So these are all moving up over, and notice that over time, these shrink because these are based on fundamental values of the company, which the buy-side institution knows because they visit all of their companies before they earnings season to know what's going on. So they're accumulating because they know that this company is going to have a great report, and then suddenly it'll blast up. This is a long-term platform market trend. It's for platform position traders, which is a slower paced, longer hold, which makes a lot of money for people who are too busy to trade every day, swing or day. Moderately trending market conditions tend to follow platform conditions or trading range conditions. A trading range is a long sideways, very, very wide. The moderately trending market has steady uptrend over many years, 8 to 15, and show up during the middle years of the long-term bull market. So we have the early days of the bull market where it's really erratic, and then it stabilizes and starts moving up slowly, or we have a platform market that turns into a moderately trending, or a really wide trading range, as in the 70s, that suddenly then becomes a bull market. Frequent minor to intermediate term corrections are common and maintain the integrity of the uptrend over many years' time. So an intermediate term correction is a good thing, and it happens all the time. It's not a bear market. This market is dominated by professional traders setting up triggers that initiate HFTs, smaller funds, and later retail traders and retail investors who always buy late. If you get in with a nudge and you can write it up, you'll make a whole lot more money than trying to get in here on this morning star. Momentum is reasonably stable for swing momentum or platform position trading. So you can take your choice of what trading style. My students usually use a combination. Retail groups often mistake minor corrections for a bear market because you can't tell the difference because nobody's taught you what you need to see. Moderately uptrending, this is just a stock chart, but it moderately trends. It moves up and down over time, and you want to do these swing trade runs or platform position as you get up, and then it will go into a velocity market for a short period of time. So this is the velocity market condition. The velocity market condition is the shortest of all the conditions, lasting a few days to a few weeks intermittently during a bull or bear market. Velocity, like moderately trending, can be either up or down. Velocity uptrending market conditions occur when the retail traders, retail independent investors, foreign and sovereign funds are buying speculatively. Oh, the market's going up. I can't wait. I can't wait. I have to buy it now. I have to buy it now. These groups have minimal to no education and limited experience, so they get very excited and very euphoric. These groups control the velocity runs, which often have no overlapping candles, as price tends to open up or slightly above the previous day's high due to rising overnight order flow from the retail groups. So we don't have overlapping candles all the time. On momentum market, we have some overlapping action. There's a difference. The angle of ascent warns traders that the trend is too steep to sustain. When it goes vertical, is going to retrace. And this signal is right here telling you, no, it's not going to last forever. Professionals always sell with great care, creating tiny resting day or profit-taking day candles that have a tiny minimal spread in points. So this is a velocity market condition over here. This was a trading range market condition. Suddenly some good news for this company, and boom, up it goes. And of course, everybody's chasing, and then it hits this resistance and it collapsed back down. Trading range market condition is the most challenging market condition to trade. I won't kid you on that. It can develop on the intermediate term trend or on the long-term trend. The longest and worst trading range market started in the late 60s with the war and ended in 1982 because of the oil embargoes and all the stress and no new technology. Leveraged corporate takeovers and skyrocketing inflation with oil prices soaring were the cause of such a long trading range market condition, which ended in a really bad recession. Also, there were no new technologies of significance during that era. Trading range market conditions occur from time to time and usually are a correction phase on the long-term uptrend that is very, very wide. So the trading range of 70s did not go down. It's still a correction, but instead of a bear market, we had a trading range. So a trading range is a form of a bear market. So that means after the trading range, the market will resume an uptrend. Special training is required to profit during a trading range market condition. Fortunately, they're very rare. So we can see up and down, choppy, very volatile, very hysterical. When you see a chart like this, just go on to the next one because you can't trade it. So the topping market condition occurs at the end of a bull cycle. The Dow's 1929 topping bull was right here. It was started in about 1916, 1917, and was a very short, about 10-year, 12-year run up. It collapsed the Dow went down 82%. That never happened again. The NASDAQ topping bull market was a very much longer. This is the 1987 broker fiasco that happened that we were able to recover quickly from. And then it went sideways for a while, and then it started the great bull market of the 2000s, had a secondary lower peak. That was when my students were calling me saying, Martha, oh, I'm out of all my long-term investments, because we do put stop losses on long-term investments, just in case, especially when it was here. I was going, okay, we need to put stop losses on those. And they said, should we get back in? And I said, no. And I saved so many long-term investments and 401ks. It's not even funny. Okay, the topping market condition occurs at the end of a bull market, the great bull market of prior eras, where 1929 and 2000, those were the greatest of all. Both great bulls occurred due to numerous new technologies of those eras, all coming to the consumer market and the small business market within the years of those great bulls. What is important in a topping market condition is that all of the retail side of the market ignore the warning signals. All of the retail groups believe that the market will go up and up and up, and speculation has become irrational exuberance and euphoria. Oh, I'm making so much money. Ooh! When everyone thinks the prosperity will go on indefinitely, that there will no longer be another bull market, that is when well-educated traders and investors start selling their stocks, as a great bear market always follows. You can't predict when, but you can be prepared for it. And when you see your index chart starting going this vertical or this vertical, it's telling you, okay, but if it's like this, no big deal. Little corrections all along the way, nothing to worry about. So yes, you can begin to not predict, but with a high degree of probability, be ready and prepared for a downtrend. So this is a topping market condition. We don't have peaks and valleys anymore. We have rounding tops. Why is that? Because rounding is where the dark pools are trying to lower their inventory of certain stocks. So they're rotating out with TWAP orders that ping in the center of this price range. So they round, it's always rounding up. And then there's flat tops at the top. And that's a new topping formation that you have not yet learned. Market participant groups. You need to learn the why and how each of the 12 market participant groups affect price and volume. Each group has a distinctly different footprint on the stock chart. The pro traders have nudges. The dark pools have triggers, TWAP orders. They're pinging on the orders and they're tracking it all the time to make sure that they get the best price. They want a bargain price. So if price goes outside of their price range, this stops. If it goes down below, they wait to see how far it goes. And if it goes way beyond, then they'll start buying and push it back into their buy zone. These are distinct patterns that you can see on the chart that you haven't learned to trade yet. So bottoms are really good right now. When stocks are in bottoms, you have the opportunity to see those footprints and those activities. HFT's gap. You see all these huge gaps on your stock charts. I'm assuming you're all using stock charts. These huge gaps show you that there's an HFT that gapped it up. You want to be in before the gap. The size of the candlestick, where it forms, whether it has wicks and tails or not, tell you who controls price at the time. Who creates all the wicks and tails on the candlesticks? Any idea? Retail traders, retail chat room groups, gurus, that type of thing, because they're trading with scared money. They have lost money and lost money and lost money. So they get, oh, well, if I could just get $200, I'd be happy. But the next day they lose 400. How much are you worth an hour? Now double that. Now triple that. You're worth more than you realize, and you should be making a whole lot more money than you are. Because if you know how to trade properly and you are following all the charts and things and the indicators, it will be easy to have confidence and know when you should enter and when you should wait, because not every day is a day to trade. The idea that you can trade every single day of the week is ridiculous. And who wants to do that? That's a lot of work. You can trade a couple days a week and make plenty of money to be very, very happy. Within each group, the trading activity is very similar. So when you have the retail groups, their trading activity is similar. When you have the professional traders, their trading activity is very similar. Any buy side, their trading activity is going to be very, very similar. Sell side, very similar. So you have these similarities. I mean, HFTs, they always gap the darn stocks. They're always gapping. If it's a huge gap, it's them. You must understand the wide disparity between the groups in terms of venues. Are they trading the lit public exchanges or the dark pool ATS venues, or buying directly from the company? Who buys directly from the company? The buy side institutions. That's why percentage of shares of institutional holdings suddenly goes over 100%. Now, how can it be over 100% institutional owners? Because they went to the company, they bought a few million shares of stock, 12 million shares of stock or something. So it pushes the PSHI out the window way above 100% until it's adjusted out in the quarterly reports. So the outstanding shares will increase at that point. What order types do they use? What's the speed of their execution? You trade on the penny. You don't trade on the penny spread. You trade on the minute scale. The professionals are trading on the millisecond scale. 60,000 times a second. There are orders going through. You're on the minute scale. Yes, you punch that little order, boom, and your broker filled. Because they're watching you as you're typing it in, because they can. And then as soon as they know you're going to do it, they send the order to the payment for order flow market maker, who pays them for their orders. They don't fill out of their inventory anymore. Nobody holds inventory. It's just too expensive for them, because you want everything to be free. You want free trading, and you want free advice, and you want free. Well, everything in the market is expensive. And so they send all your orders. They like them. So everybody knows, oh, this memes group is buying this stock. Okay, let's front run it. Before they can get their orders filled, they're already front run. So it's speed of execution, access to information. You have very limited access to information. You have the webinars, you have the internet, you have the retail news, but that doesn't tell you anything about the professional side. You know nothing, because they don't tell you anything. I get information from the professional side every day, and I share it with my students. What lot sizes are they using? You use 100 shares to 1,000 shares, maybe 5,000 shares. Smaller funds are trading 50,000 to 100,000. Giants are trading 1 million to 5 million shares on a single trade. And why are they buying that trade? Why are they trading it? The intent. Are they holding it long-term, short-term, swing trading? You need to know all this stuff. Over the past few years, the financial markets, especially the stock market, have fractured into a multi-venue structure that has never existed before. We are the first digital-based economy in the world. We have the largest stock market and all the other financial markets. We are amazing. We are amazing. And you can be part of that amazing. Because it doesn't matter what the economy does. It doesn't matter what's going on in the world. If you know how to trade with the professionals, you can always make money in the market. Confidence is something that automatically happens. You don't have to think about it. You don't have to look in the mirror and tell yourself you're confident or that you're good or you're great. If you have the resources, if you have the knowledge, if you have the skill, the experience, you will have the confidence. It just comes automatically. You don't have to try to force fit it into you. It's there already. It's just waiting for you to get the knowledge. So, market condition analysis. Who of the 12 market participants is in control of price? In bottoms, it's always going to be the dark pool buy side, always. If it's running up out of that, it'll be pro traders. It'll be sell side institutions pushing price with buybacks or whatever they're doing, presenting a new IPO. They're very much in control. Retail traders will be at the top, speculative, buying irrationally. What technical patterns are prevalent and reliable for that specific market condition? It changes. The technical patterns change based on who is in control of price. How price will behave at resistance and support. Resistance and support for a swing trade is different than a day trade. Resistance and support for a platform position trade is different because the different levels of support matter depending on who is in control of price. What trading styles work best in that market condition? Not every trading style works great in every market condition. If you have a really volatile market, you're not going to want to try to day trade. Which indicators to use? We use hybrid leading indicators that are just like the professional side because I came from the professional side. The inherent risk in trading specific styles. There's a lot of risk for day trading. There's a lot of risk in some of the other financial markets as well because it's so volatile. And if you don't have tons of experience, it's very hard to do. It sounds easy. Oh, here's a buy and you get in and then a couple minutes later you get out, but you don't realize that you've got this millisecond trading going on in the background and here comes a freight train, boom, slamming into you and you lose money. What trend line patterns are common? It's not just the trend, it's trend line patterns. And I teach those very specifically for what's happening. Which entry and exit signals are most reliable? You have to use candlestick entry and exit signals with confirming indicators, not the other way around. An indicator is smoothed and averaged and changed and adjusted. You use them as supporting evidence of the high probability that that entry signal, and you need to use the modern leading candlestick entries, not the older ones, because you've got springboards, you've got pushes, you've got nesting candles, you've got nudges. Those are all you things you need to learn that you don't know. The strength of the price and volume patterns. How strong are they? You get that with a subordinate indicator over the other, but price is always candlesticks and using the modern leading candlestick patterns that are out there. Market condition analysis tells you how and when to trade, who is controlling price, what to expect in near-term price action, where to find excellent picks, how to enter, and when to exit. Market condition analysis is a roadmap of which market participants are actively trading, which are sidelined or waiting. And right now in our market, retail is sidelined and waiting. Smaller funds are sidelined because they've got burned so badly. And where we are in the overall long-term, intermediate term, and short-term trends. This provides the relational analysis needed to navigate the complex marketplace. It's complex, but it's not something you can't learn easily. You just need to lay it out in systematic. That's why I ask you to write some notes down. That's why I'm slowing down here. So those of you who are scribbling furiously can take notes. So this is an example of a professional analysis of the market. I share this with my students. They get this format. And so I'm saying to myself, I want to know how many stocks are moving with momentum to the upside and how much momentum is there on the percentage of change. I want to know how many stocks are moving to the downside and the percentage of change of that. Based on these two momentum analyses, we can tell whether the bias is up the next day or down. It doesn't matter what the indexes are doing. The indexes are not harmonious with the broad base of stocks. The indexes are doing their own thing. Right now, they're being supported by the sell-side institutions, so they're moving up. They're trying to keep them up because they need the stock market to be moving up right now because banks have a lot of investments going on, trading going on. They need them to move up. So if the momentum is to the upside, the next trading day, you should be looking for buys. If the momentum is to the downside, you should be looking for stocks to sell short. You all need to learn to sell short. It's not ripping somebody off. You can have 4 positions in a stock. Buyers buy to covers, sellers sell shorters, and they can all make money. Long-term investors, it doesn't matter. You don't need to worry because if they hold, they'll be fine. So short-term trading is different than long-term, so shift your head out of it. So this tells me the bias of the market for the next trading day. Then I ask to see all the stocks that show dark pool buy zones. And of course, we have HFTs chasing them, so we can see what's going on there. Then I ask for all the stocks that are bottoming. Give me a list of how many stocks are bottoming. This tells me a lot about where we are in the market conditions and what market condition we are in. Then I ask for all the stocks and consolidations. Now, why would I ask for stocks and consolidations? Anybody? Because this is where the professional traders are. They're making small nudges. Their price changes are tiny. So I need a consolidation. I need to say resting day patterns. I need to say very small pre-buy signals for a springboard, that type of thing. And then I ask all the stocks that are turning in a trading range, turning down in trading range. This tells me if we have any risk of having a lot of stocks shift to trading ranges, and we aren't. And then we have, I want to know price relationship comparison. Based on today's price versus so many days back, has there been improvement in the broad base of stocks? Yes or no? This tells me if stocks are stalling and slowing down or if they're going to continue to accelerate. It also gives me an idea of how much velocity or momentum we will be having if retail traders step in. This information is shared on the market condition analysis report before the market opens every day and the market open report that I provide to my subscribers. So this is something that's very important. It sets the tone. They absolutely love it. They eat it up. It's a very detailed report of everything that's going on, plus all the other financial markets. So it's great. Tools for trading any market condition. Market condition analysis. You must have market condition analysis, which I provide to my students. Relational technical analysis is the comparison of price action to identify who is in control of price of the market participant groups. You need a trade management planner. Howard Johnson designed this. What this does is all you do is plug in the numbers for the month. You have so much capital. You have so many days that you want to trade. It spits out the lot size you need, the range of price that you can trade, how many days you're going to trade. It actually tells you how many stocks you need to trade to make the money you want to make that month. It's awesome. And when I saw it, I said, my students need this. And so we shared it with them. My daily trading journal is a professional journal, and I provide copies of that for my students so they can fill out theirs and compare it to mine. Charting software that includes scans and sorts. So we provide personal scans that I've created and sorts, personal sorts. So it's really fast and easy to find stocks to trade. We feature the hybrid leading indicators that we provide to the students either in their charting software program, if they have one charting software that we support, or that they can plug into their public version of their thing like TradingView. Controlled bracketed order types. Howard Johnson created this new controlled bracketed order type for our trading floor years ago. And we decided we were going to teach because I was bored in early retirement. And I came into his office one day and he was laughing and joking. He said, who are you talking to? I said, the market maker. I was freaking out. Here he's talking to New York Stock Exchange market makers. What are you doing? Are you insane? They never talk to people like us. And he's just, and so he got off the phone. The market maker was so impressed with Howard's new controlled bracketed order, he asked permission to use it on his floor. And today Howard's bracketed order still exists on the professional side. We share this with you. Only my students. Nope, you can't buy it. Buy entry signals, sell short entry signals, because you have to learn how to use it properly. It's sophisticated. Buy entry signals, sell short entry signals that are modern and leading the market. These are different than what you learned. If you've learned candlesticks from the books or from other people, that's great. But those are the old ones. It's not 1999 anymore, folks. And there are new buy entry signals because of the penny spreads, because of the decimals. Everything's changed. And so you need to learn those new candlestick entries, exit signals, or trailing profit stops for taking profits. So you need to know when to exit, because some of my indicators indicate the day before the stock will start to move down, so then you can sell into that new little bump up before it starts going down. It's really so cool. And so trailing profit stops, do write this down. I will never use percentage stop losses again. Percentage stop, they can see your orders, guys. Everybody can see, because the retail brokers have to like your orders. They can see what you're doing in the chat rooms. They can hear you on social media. Anything that's public, chat rooms, gurus, social media, you're all talking. They have AI tracking, seeing what you're doing, and that's reporting back to them. So they're way ahead of you. Don't use percentages. They'll front run you. Run gain potential calculation. What is that? You need to calculate how many points the stock can move before it'll hit resistance based on your trading style. Nobody does that. Trade Calculator 4, automatic risk analysis, does it for you. You just plug in the numbers. Technical trading style, stop loss placements, automatically does it for you. Entry price for controlled bracketed order types, automatically does it for you. Share size, your share lot size, price range, risk to profit ratio. You always have to calculate the risk versus the profit ratio. Estimated hold time and exit point. You know, before you get into a stock, pretty much what you can expect. Okay. I wish to God I'd gotten here 17 or 18 years ago. I can't tell you how many times I've heard that comment. I hear it all the time from my older students who've been trading for a long time. They're so frustrated. They're hobby traders and they want to do better. And it's the biggest mistake they make is they can't figure it out on their own. It's not a do-it-yourself situation. It's not like learning how to put asphalt roofing on your home or fixing your older car or your motorcycle. It's not something that you can get together with a group of guys and sit and everybody will share ideas of how to fix that gutter problem. It doesn't work that way because you don't have anybody from the professional side to tell you what's going on. You need a supportive, comprehensive training course is mandatory if you want to succeed in the modern automatic market and make the money that professional traders make, and they make millions. They just don't tell you about it. They're not on the news. They're not promoting things. They're not telling you they're the greatest trader in the whole wide world. They're too busy making money. They can't be bothered. And they are reclusive. They don't want to share their ideas. They don't want to give you all the information. I do it because I get bored in retirement and it's fun for me to teach people and see the success. And I'm so proud when someone comes back to me and says, Martha, I'm trading $100 million hedge fund. Thank you for teaching me. That's what gets my bunny happy. I'm just really happy. Without a trading process that gives you a complete step-by-step detailed roadmap to consistent results, you will lose more money than you make. Do not struggle for years and years. All you will do is erode your capital and your confidence will disappear immediately. It is far more difficult to get rid of a very bad habit than to learn how to do this correctly in the first place. Give yourself the gift of a good education because you deserve it. Oh, I can't afford it. I can't afford it. You can't afford not to. You can't afford not to. So the technical difference is you are learning from professionals. I'm a retired buy-side professional. I have I am licensed to teach and to teach technical analysis. We have been in business almost 27 years, starting in May. TechnoTrader staff continually update and improve the quality of our education. I am writing a new definitive guide to stock indicators course right now. I'm going to have about 400 hours of time into it. So it's no small feat. We use a studio and we have all kinds of things that are going on to make sure that the quality of that education is better. That's why we are the gold standard of stock market education. All of our courses are updated regularly. We keep our students up to date with all the new trading instruments, changes to the internal market structure, and how professionals are trading the market. It's constantly evolving and changing. It's not 1990 anymore. It's not 2005 anymore. It's not 2020 anymore. We have communities and discussion groups where both professional level students and beginners can share ideas. Now, what's different about my communities and discussion groups? They're private. If you're not a student, you can't get into them. So the HFTs and all the others that are hunting down the public ones can't get into my communities and groups. And right now we have a topic that we're working on that's called trade deficit. Is it good or bad? Is it a good or bad thing? TechnoTrader has the most comprehensive support, guidance, and so on, with access to a vast library of help files that I've assembled over 30 years, articles, and ongoing new information about the evolving market structure. I even provide a market structure report so that you understand how the market structure works. We offer 3 different courses designed around your individual training needs. Maybe you're brand new, so you start with the standard, or maybe you've been trading for a little while, so you need the premier. Or maybe your goals are that you want to be a semi-professional, professional trader, trading as a business with an IRS status for that tax purpose, so that you can write off all of your expenses of trading. You can't do that if you're a hobby trader. Some students advance to the professional level and work for institutions. I have several. The course can be taken at your pace, when you have time, and when you are ready to learn. Our courses contain the body of knowledge, experience, and expertise of our founders. I started learning about the stock market at the age of 12 from my grandfather. This foundation of knowledge is taught nowhere else. You can't get it anywhere else. So you can test drive by going to TechnoTrader.courses. Test drive our education, see what it's like, see how it feels. It's similar to what I'm doing here, but these are all mini courses, and I don't charge anything because I want to see if you're interested. And you may not be, but you can still take them. Take them and go through them and study them and see what's going on. We're a niche market. We're not trying to get millions of people. We're just wanting to get those few traders who really are serious and really want to make a good living in the market and never have to worry about what the economy is going to do or the world's going to do or if terrorists are going to do. You don't have to worry about that stuff. Stock market's always going to be there. And there's always ways to make money. I know I can always make money. I can always make money. That's confidence. That's confidence. So come and check out. You have to register for them, but we won't harass you to death. The reason we have you register is sometimes people start it and then they get distracted. And so we'll send you a little nudge. Hey, let's come finish your little course. That's pretty much what we do. So now that you've gone through all of this and you've watched all of my stuff, and I hope you aren't bored to death, you have 24 hours to claim your gift. And this is a massively important gift. It's a student mentoring session replay, and you can get it by visiting this little thing or using your phone and clicking on that. It's a $200 value. You get it for a free, you get a free peek into the TechnoTrader student experience because I'm talking to my students. They're telling me charts. We're asking questions. We're going back and forth. You have free access for 1 week. The coupon number is STO325 to register. It is fun, and you get to start with something that gives you immerses you in the student experience. And I haven't ever done this before. So this is something that you should all take advantage of. Even if you don't want to be a student, even if you just want to get more information, get more knowledge, you can. Like I said, I'm only looking for that rare individual who's really determined, who really knows that they can succeed, that just can't figure out what's missing. That's what I'm looking for. And you will do extremely well. For those of you who are really, really intensely interested in being successful and are tired of running around trying to figure it out for yourself. Okay, so I have a minute for questions. And I can't see the questions. So can anybody read anything to me?
Okay, one, I think we have time for one. Um, two, two questions. What do you mean by sell side supporting the market? And
Sell side supporting
oh,
the market means they are moving in and they're using their own money from the bank to push the price up just enough to get the retail traders back in to buy stocks. It's called support the market. Sell side does it, buy side does it. Yeah. They're definitely
okay.
pushing